Here is a long-form YouTube script crafted exactly to your niche and structure, optimized for high retention, delayed answers, and curiosity-driven passing. The silent banking agreement that turns citizens into collateral dramatic hook. The question no one asks: what if your money was never really yours? What if your savings account wasn't a vault, but a pledge? And what if, without a single vote, announcement, or headline, you were quietly reclassified from a customer into collateral? Most people believe banks exist to protect their money, but buried inside modern financial systems is a silent agreement rarely discussed, rarely explained, that flips this belief upside down. Tonight, we uncover how citizens became the last line of defense for a system designed to fail safely for banks, not for you. And the most unsettling part? You already agreed to it. Setting the stage. How trust became a tool. To understand how this happened, we need to rewind. Banking was once simple. You deposited gold. The bank stored it. You paid a fee. The gold stayed yours. But over centuries, something changed. Gold left the vault. Paper replaced metal. Trust replaced proof. By the 20th century, banks no longer held your money. They held promises, backed by confidence, government guarantees, and something called fractional reserve banking, the ability to lend out most of what they received. This worked as long as nobody panicked, but history showed a problem. When banks failed, governments stepped in. Bailouts became routine. Losses were socialized. Profits remained private. After every crisis, leaders promised, never again. And then quietly they rewrote the rules. Origins. The birth of the silent agreement. The real shift began after repeated global crises. The Great Depression, the savings and loan collapse, the 2008 financial meltdown. Each time, governments rescued banks with taxpayer money. Public anger exploded, so regulators searched for a solution that wouldn't look like another bailout. Their answer: change ownership on paper. Under new banking frameworks, deposits were no longer treated as your property. They became bank liabilities. Legally, when you deposit money, the bank owns it and owes you an IOU. This legal distinction changed everything, because in a crisis, liabilities can be restructured, and that's where the silent agreement begins. The rise from bailouts to bail-ins. After 2008, global financial institutions quietly coordinated a new plan. Instead of governments rescuing banks, banks would rescue themselves using depositor funds. This mechanism is called a bail-in. Under bail-in rules, if a bank collapses, it can legally convert deposits into equity, freeze withdrawals, or write down balances to stabilize itself. Depositors become shock absorbers. This wasn't debated in public squares. It was negotiated in regulatory rooms, codified in policy documents, and embedded into banking law across multiple countries. Most citizens never noticed. Why would they? Nothing seemed to change. Until it did. Breaking point when theory became reality, then came real-world tests. In multiple financial crises, depositors suddenly discovered access limits, withdrawal caps, or outright losses. Accounts were frozen. Balances reclassified. Funds converted. The shocking realization hit late. Deposits were no longer guaranteed possessions. They were conditional claims. Banks survived. The system stabilized. Citizens paid the price, and the precedent was set. Fallout. The hidden cost of stability. The fallout wasn't just financial, it was psychological. Trust eroded. People learned that insurance limits exist, that access is an ownership, that emergency powers override contracts. Most never connected the dots, but the system had changed permanently. Citizens weren't just participants anymore. They were buffers, collateral for systemic risk. Failed fixes. Why reforms didn't protect you? Regulators promised safeguards, capital requirements, stress tests, insurance schemes. But these fixes share one flaw. They protect the system, not the individual. Deposit insurance is limited, emergency powers are broad, and transparency is optional. The silent agreement remains intact, because from the system's perspective it works. Modern parallels the pattern repeating today. Global debt is higher than ever. Banks are more interconnected. Digital money makes freezes instantaneous. And once again, the same logic applies when risk concentrates. Losses flow downward. The pattern repeats quietly, legally, predictably. 3 clear takeaways. First, a bank deposit is not stored wealth, it is a loan you gave the bank. Second, in crises, depositors rank below institutions in priority. Third, stability is often achieved by shifting risk, not eliminating it. Final warning. The question that matters: the silent agreement wasn't designed to hurt you. It was designed to save the system at any cost. The real question isn't whether it exists. It's whether you understand it before it's activated again. Call to action. If this changed how you see money, banking, or safety, subscribe for deeper dives into hidden financial mechanics, monetary history, and economic because the most dangerous systems aren't the ones that fail loudly. They the ones that work until they don't.